प्रेजेंटेड बाय ईबिक्स कैश। हर खुशी के लिए काफी है।
Hello and welcome. You're watching the Business Today show with me, Chaiti Narula. Lot of business news making headlines. But first up, let's take a look at our top stories. The market ends higher amidst volatility. Nifty reclaims 17,050 mark. All sectors in the red excepting IT and financial services. RBI supersedes the board of Anil Ambani's Reliance Capital to begin insolvency process soon, says serious governance concerns at the company. Kotak Mahindra Bank surges as RBI approves LIC's proposal to hike stake in the bank to nearly 10%. No proposal to recognize Bitcoin as a currency, says Centre in Parliament, even as it prepares to table a bill to regulate cryptocurrencies. And Rajan Bajaj, a 29-year-old tech entrepreneur, fulfills a dream as his credit card company becomes the 41st startup to turn unicorn this year. We're beginning the broadcast with the markets encapsulation. Markets ended on a positive note today. That is Monday, rebounding after the worst single-day plunge on Friday. A choppy session indeed ended in the green, with the Sensex ending 153 points higher, still below the 58,000 mark. Nifty too rebounded, barely holding on to 17,000 mark. Amongst the Nifty top gainers, Kotak Mahindra holding fort right there. HDFC Life, Titan leading this particular surge. Tech stocks were also buzzing in trade in the trading session. TCS and HCL Tech were amongst the top gainers in the sector in the intraday trading session. The losers included BPCL, Sun Pharma, Adani Ports, UPL and NTPC. So then the markets are back in the green after a volatile last week, with the fear of the third wave looming large amidst rise in cases of the Omicron variant that we're seeing all over the world. Where do you think the markets are headed now? Are we now giving in to panic?
It's impossible to say. I think today was reasonably well behaved after what happened on Friday, and people would have been very apprehensive on where we'd end up. But I think we came out quite okay. The market has slipped quite a bit from its recent high. I mean, Nifty was about 18,500 just a few weeks ago, and now we have slipped all the way down to 17,000 levels. So one level of the correction has happened. And I think now everybody is waiting and watching to see if we really get a scare from this Omicron virus, globally and locally. I think markets would probably give it the benefit of doubt for a couple of days to figure out how things are shaping up. Because even in the past, where there have been these intermittent scares from the COVID spectrum, markets have actually stabilized. They don't get as scared as they did in 2020, because they've seen what happens when there is a panic after COVID, some kind of COVID news. The markets inevitably bounce back. And in the past, it has worked to buy these panics and not to sell in them. And that experience, I think, also informs investor behavior at the current time. This is not to say that the markets may not correct more from here, because the run-up has been stupendous and there is every possibility that the markets see a deeper correction in the weeks to come. But I think the first flush of the fall and the panic has already happened, and how markets move from here on after consolidating will depend squarely on what kind of news comes in from Omicron internationally as well as locally, in terms of discovery of any kind of cases or not. So fingers crossed, but I guess it is safe to say now that that 18,500 level for the Nifty will remain probably as the top of the year. And if we can get through the remaining part of 2021 without too much price damage, I think that will be well done.
Well, with the markets experiencing volatility, is the long-anticipated correction really setting in? What are the factors leading to the downfall? Let's now listen into what our Market Guru Saurabh Mukherjea has to say on this.
Some clouds gathering over the skies after a long time, whether consistent compounders will continue to be holding out for investors. Saurabh, it's good to see you again, and thanks for joining in today. But how are things looking for the consistent compounding universe, given that some COVID clouds have gathered on the horizon again?
I think, as they say, right, when the going gets tough, the tough get going. So it's always good to have some clouds in the horizon. We worry about the days when people tell me that the sky is blue and there's a 3-year economic recovery with no interruptions ahead. There are bound to be some challenges from COVID. I suspect there'll be some other challenges as well, including the rate rise cycle. And consistent compounders are geared to deal with such challenges and plow through with around 25% free cash flow compounding, which has been their habit over the last couple of decades.
It's interesting that you speak about some clouds because till a month back, everybody seemed to be so gung-ho about the market and everybody was talking about a new capex and earnings cycle. Did you worry a little bit then that, if indeed it's a new capex cycle, then while consistent compounders do well through different weather systems, sometimes in a pronounced capex cycle, they tend to take a bit of a backseat. Were you beginning to get a bit worried about that?
So I think what we were worried about is the sort of the more fundamental manifestation of a roaring capex cycle. If you look at our country, typically when the capex cycle really gets going, CPI inflation fires through at 9-10%, right? So if I cast my mind back to say 2011, when I think that was the last time the Indian economy really was heated up, CPI inflation at 10-11% creates input cost challenges. Wage inflation tends to go to 20-25%, and that was something we were worrying since last November, December, and we'd engaged quite intensively with our investee companies coming into the second wave of COVID about their plans for high input cost inflation. And what we learned, left us feeling fairly confident that as input cost inflation comes through, our investee companies will be able to use that to gain market share from weaker competitors who don't quite have the strength either in terms of, say, working capital or in terms of bargaining power to deal with input cost inflation. So my view is, regardless of whether the second capex cycle comes sooner or later, I think input cost inflation will now be a recurrent theme in India for the next couple of years. And basis what we have seen so far in our discussions with our investee companies, we think they're very well placed to deal with the margin pressures that will now mount as we get into a more active economic expansion mode in our country.
What about financials, Saurabh? Because that's been the one sore point. I mean, while they have not collapsed or anything like that, even the good ones have not exactly outperformed or kept pace with the index. How do you read this phase for some of the bluest of chips in the financial space, like the ones you own, like HDFC and Kotak, etc.? Why are they not outperforming, even when people talk about a new capex cycle and a new earnings cycle? Why are they not participating?
So then I think this is a movie that many of us have watched several times before, which is that the early part of an economic cycle, where the previous cycles crumpled financials suddenly show surprising asset quality development, positive surprises on the asset quality side. So the early part of the economic cycle, the previous cycle's casualties show significant asset quality expansion, and they seem to get a fillip in their share prices as the market gets pleasantly surprised. But then as the economic cycle wears on, typically you see the tried and trusted proven lenders, HDFC Bank, Kotak Bank, Bajaj Finance, tried and trusted proven lenders who've got the ability to manage risk well. Their asset quality holds up much better over a cross-cycle period. So we've been very sanguine that we don't want to invest with adventurous lenders who've shown repeatedly over the last 20 years that they put shareholders' money at risk. We understand that the adventurous lenders will outperform the more tried and tested names in the early part of the economic expansion, and we're quite comfortable with that. Our view is, let's take a 5-year view, and we are pretty confident that the names that we are backing will comfortably outperform the more adventurous lenders who characterize the Indian banking and NBFC landscape.
Not just the banks, the biggest wealth creators. I mean, let me ask you a bit about some of the consumer-facing financials, like the Bajaj Finances of the world, which feature prominently in your list of consistent compounders. How do you think they are positioned now to face the challenge of these fintechs which are coming up every day? I mean, there is Bajaj Finance, but on the other hand, there is all these Paytms and Creds of the world who are trying to nibble away. Do you think Bajaj can grow at the kind of pace that we have got used to, that kind of compounding in the face of these new challengers?
So I think 3 points to note. The new challenges, without exception, are very small, right? They create a lot of news, they create a lot of hype, and God bless them, they sponsor a lot of things on TV and in IPL and so on. And a long may that continue. But if you see their loan book sizes, they struggle to get to even say 1,000 crores of lending. So in terms of actual practical impact on the lending landscape, it's negligible. Where their impact is substantial, I do concede, is the hype that they create. But the shareholders not going to make money through hype, and neither will I lose sleep about the hype that they create, given that the loan books are so small. I think the second aspect is, if you look at the scale of the NBFC opportunity in India, there's Bajaj Finance is barely 3% of the loans outstanding in the NBFC sector, and hence the runway is considerable. So far, actually, Bajaj has only dominated two areas of lending comprehensively, which is consumer durables and the self-employed, white-collar self-employed financing space. There's plenty of canvas for Bajaj to expand in, and the app that they're coming out with, to my mind, will probably be a significant disruptor of the broader NBFC space and even the wallet space. And the third aspect is just the sheer amount of investment. Bajaj Finance, if you look at their annual reports and their disclosures, plus speak to the tech community in India, Bajaj Finance invests significantly more in tech talent. Say the best computer engineers coming out of the IITs. Bajaj Finance hires way more of them than any of the disruptors do. And if you say the amount of engagement a Bajaj Finance has with a platform like Salesforce, it'll manifold outstrip those that of the other pretenders that one mentioned. So whether in terms of real investment in fintech or in terms of real business creation, I think by far Bajaj Finance, followed, I would suspect, by say the HDFC Group and the ICICI Group, would be actually the real fintechs in the country. Most of the rest of the guys are pretending to be fintech, but it's a tough slog out there to actually lend money on the ground and get it back in India.
Tell me about how you're approaching this whole digital universe, because while you don't balk at high valuations, you have very stringent metrics like return ratios, etc., cash flows. On those parameters, have you just given these digital unicorns, or the ones which are listing, a clean pass, or do you think some of them eventually can become consistent compounders?
So my guru John Kate taught me long ago, 20 years ago, on Sholdham Street in London near Paddington Station. John would have a cup of tea and teach me that the definition of a business model is how a company makes money. So if a company doesn't make money, then by definition, the business model isn't there. Now, that being said, there are some of our technology companies in India, some newer companies, who are generating operating cash flow in their core business, say the one that they began with a decade ago, and then they're reinvesting that cash flow. They're reinvesting the cash flow in say newer adventures in other parts of India, right? And so when we meet these new age companies, we ask them, tell us where you started a decade back or 5 years back, and show us whether in your original business you're generating cash flow.
And you can watch this full interaction on businesstoday.in. Reliance Capital has been taken over by the Reserve Bank of India. The central bank announced it has superseded the board of Reliance Capital in view of the defaults by the company. The RBI has also said it has serious governance concerns, which the board has not been able to address effectively. The balance sheet of the company for the period ending September 2021 shows the Anil Ambani-led company with total liabilities of 79,031 crore rupees. The Reserve Bank of India will shortly initiate the liquidation of Reliance Capital under the IBC law. And banking major Kotak Mahindra Bank clocked in a handsome gain in trade today. The stock rallied nearly 3% after LIC raised its stake in the bank to nearly 10%. The rally was also fueled by RBI raising the permissible promoter holding in private banks to up to 26% from 15% earlier. LIC earlier held 4.96% stake in Kotak Mahindra Bank. The promoters, Uday Kotak and family, hold 26% stake. Rakesh Jhunjhunwala-backed Star Health and Allied Insurance IPO will open for subscription tomorrow as the company looks to raise 7,249 crore rupees from investors. Shares of Star Health and Allied Insurance are going to be available to subscribe at a fixed price band between 870 to 900 rupees per share. However, there is a catch here. Between 2019 and 2020, Rakesh Jhunjhunwala bought 7.68 crore rupees worth of shares in 8 transactions for a 14% stake in Star Health and Allied Insurance. He bought the shares at an average price of 156.28 rupees per share. The company has now set a price band of nearly 900 rupees per share. That is over 5 times the price at which Jhunjhunwala bought stake 3 years ago. Star Health's IPO is going to be a mix of fresh issue of equity shares for an offer of sale by existing shareholders. The fresh issue size of the IPO is 2,000 crore rupees, while the remaining 5,249 crore rupees is in OFS. And after receiving a tremendous response for its IPO, now Go Fashion is expected to make a blockbuster debut on the bourses tomorrow. Going by the demand in the grey market, Go Fashion is likely to debut with a 65 to 70% premium. The IPO was subscribed 135.46 times. The shares are available at a trading price of over 1,000 rupees per share in the grey market against an issue price of 690 rupees per share. It is the 41st startup to achieve the unicorn status this year. If you're not a millennial, you probably haven't heard of the company. It's called Slice. What it does is issues credit cards to youngsters without grilling them over their credit history. And the founder is just 29 years old. Take a look.
Rajan Bajaj turned 28 in December last year. Then, in a tweet in January, he wondered out loud what he needed to do to have his company Slice turn unicorn before he was 30. 10 months later, his dream was fulfilled, with Slice turning into this year's 41st unicorn, a company valued at over $1 billion. Monday morning saw another tweet from Bajaj, a tongue-in-cheek reference to the old post, reminding his followers that he was turning 29 next month. So who is Rajan Bajaj? He is a civil engineer from IIT Kharagpur who did short stints with Walmart and Flipkart. He struck out his own with Mesh Internet in April 2015 before shutting it 9 months later. Bajaj launched Slice in January 2016. Slice, in short, is a company for millennials by millennials. What it does is issue credit cards to youngsters who would normally be rejected by banks. Backed by Visa, these cards are accepted by vendors across the world. The numbers are also impressive. It has around 50 lakh users with an average age of 27 years. In January this year, it issued 20,000 cards, which rose to 2 lakh cards in October, making it the third largest credit card issuer. The company claims a waitlist of 10 lakh users. It offers credit limits from a low of 2,000 rupees to 10 lakh rupees. Importantly for its customers, it requires no credit history checks. The company has raised $20 million in June this year, valuing it at $200 million. The latest fundraising round saw an infusion of $220 million, jacking up the company's value fivefold in 5 months to $1 billion. Bureau Report, Business Today Television.
And businesses are once again staring at a period of uncertainty. Thanks to the latest super mutant variant of the COVID virus, Omicron has struck at a time when the global economy was finding its feet, slowly limping back to normalcy. Enthused by the rising Christmas demand, now fresh lockdowns and precautions are threatening to cast a shadow on this sentiment. Here's a look.
Nervousness in stock markets across the globe is back. Global economies threatening to derail from the path of recovery. Countries reimposing lockdowns and travel bans. Feeling of deja vu? Well, with the new COVID variant Omicron spreading its tentacles across the globe, fear of another outbreak is gripping the world. While many believe that Omicron may deal a blow to the world economy, which was limping back to normalcy. Others are of the opinion that we can't let paranoia rule us. Omicron has triggered a massive scare in India as well. The country, which has decided to resume international flights from December 15, has now issued new guidelines for international travellers from affected nations. The move comes after Omicron crossed borders to spread to more than 18 countries so far.
For all passengers coming, with the travel history, which will be seen, you have laid down necessary norms. So we will follow that and see how things go.
Brokerages like Morgan Stanley believe that with the majority of people vaccinated, the downside risk to growth could be less compared to mid-2021. JP Morgan too sounded optimistic, saying if the variant is contained, countries might reconsider reopening of international borders. India Inc. too believes that instead of jumping the gun and giving in to panic, a well-calibrated response is the need of the hour. Uday Kotak welcomed the netizens of the never-normal world we live in, adding that Omicron will prompt people to shoot from the hip in crisis management without data. Biocon's Kiran Mazumdar-Shaw also wondered whether a 7-day home quarantine for visitors from at-risk nations was too drastic. Anand Mahindra wondered if and how markets will be impacted due to this development. Meanwhile, stock markets still can't decide what the impact will be. While the fall last week was drastic, markets recovered smartly from a plunge early Monday morning, instilling some confidence among investors. Bureau Report, Business Today Television.
And meanwhile, all of this talk of an Omicron variation, which is a coronavirus, has had an interesting side effect. A relatively unknown cryptocurrency, which is sharing its name with the COVID variant, which is Omicron, has zoomed 900% in the past 2 days. That's correct. 900% rise in 2 days itself. The Omicron crypto has hit an all-time high of $689 this morning. It was selling at just over $50 on Saturday. Interestingly, none of the exchanges have any information on this crypto, rather not too much. And days ahead of the cryptocurrency regulation bill being tabled in the Parliament, Finance Minister Nirmala Sitharaman has made it clear that the government has no intention of recognizing Bitcoin as a currency in India. In a written reply to a question, the Finance Minister also informed the Lok Sabha that the government does not collect data on Bitcoin transactions. The government has listed the Cryptocurrency and Regulation of Official Digital Currency Bill 2021 for tabling in the current session, which is the winter session of the Parliament. The Reserve Bank of India has proposed that its digital currency be included under the definition of a banknote, even as the debate is raging on over what a cryptocurrency is and how it should be regulated in India. The central bank has now sent out a proposal to the government over how it would define its central bank digital currency. According to the government, a central bank digital currency will provide significant benefits, including reduced dependency on cash, higher signage due to lower transaction costs and reduced settlement risks. Well, that's it from me, Chayati Narula on the Business Today show. Thank you for your time. Thanks for tuning in.